So what are the business applications involved? Because we're only going to look at monetary policy, these are some things that we're going to be looking at. How do you change the supply of tokens? What are the interest rate considerations? Something people like to talk about is inflation and deflationary features, distribution factors, exchange rate regimes, and the reserve ratio, or I like to call leverage on collaterals. I think they're quite similar in terms of concept, in terms of foundational concepts, but they are very different on its own. So, supply of tokens. The most basic decision is, do you want to have a fixed supply or a fluctuating total supply? So, because Bitcoin is one of the pioneers out there, they have kind of like a fixed supply, because they say that because of the mathematical formula, when you calculate it, there's only 21 million Bitcoins in existence. So it's a fixed total supply. And it works. A lot of people are holding Bitcoin and investing in Bitcoin. So a lot of other projects are just trying to follow and copy this model. It might work, it might not work. It really depends on the objective of your tokens. But during like 2016 to 2018, a lot of projects have a fixed supply and they're just copying the Bitcoin model and say that this is the total number of tokens that I have in existence, and then so you can calculate backwards and say that this is the price of tokens. So that's one method. The other method is a fluctuating total supply. So there'll be as much tokens there will be out there depending on demand, and it changes. It will mint and burn according to the market demand. So it's a fluctuating mechanism. So because of that, you want to consider how is the supply of the token determined, and what is the expected growth of supply. So both of them, both fixed and fluctuating, you can have an expectation of the total supply or expectation of the growth of supply. This could be mathematically with Bitcoin's calculation, or it can be driven by market demand, because Ether is on the Ethereum platform, and a lot of people are using Ethereum. They're building their projects on Ethereum. So maybe you can expect Ether to grow more because market demand, maybe. And because of the expectations, you have to take the expectations of growth into supply, because your participants are going to consider that when investing or buying your tokens. And then how do you determine the correct monetary policy relevant to affect the supply of tokens? And also, how the supply of tokens determined? Is it by collaterals? Is it mathematical? Is it by minting? There are many ways to determine the supply of tokens. The other one is effective lower bound. So as I mentioned, effective lower bound is the lowest interest rates that central bank can give to stimulate growth. Usually it's used to be 0, but now it seems to go lower than 0, it goes to negative. So interest rates affect people's willingness to spend and to use the tokens. When you have higher rates, then it's more expensive. People will spend less because it's expensive to rent money and spend. When the rates are low, then it's cheaper to be borrowing money, and people want to borrow money and spend more. So it affects people's spending. And the lowest rate, we used to think the lowest rate is 0, but now, as I mentioned, we are seeing negative interest rates, which is interesting. So that can be something to play with. Negative interest rates. Negative interest rates is where, if I want to keep money and it has a negative interest rate, then it's better for me to be spending the money, because for every period that I'm saving the money, negative interest rates is where you get money. So interest rate is basically rental money, right? And negative interest rates means you get money for instead of paying rent for borrowing money, you receive money for borrowing money, which is negative interest rates. So instead of paying rent, you receive rent for staying in a house. Now, of course, you want to stay in a house. So then you want to borrow more money because you get additional money, and then you will be spending it. It's a way to stimulate the growth and stimulate the ecosystem. Another way to look at negative interest rates is, another mechanism is to look at tokens with an expiry date. So the tokens can be used only for 6 months, and it needs to be used within 6 months. And usually for negative interest rates and tokens with expiry dates, the objective of the ecosystem is to stimulate a lot of growth, is to stimulate tokens being used in the ecosystem, is to stimulate a lot of activities and transactions in the ecosystem. So negative interest rates are positive like incentives, because when you borrow money, you get additional money. It's like buy one, get one free. And tokens with expiry dates, it's like a punishment. If you don't use your tokens by that date, you lose your tokens. So these are incentives and punishments to affect people's behavior. When you have these kind of mechanisms, people want to be spending money, because for the negative interest rate, the buy one, get one free, you get more money when you borrow, and then when you borrow money, you spend it. Or you invest it somewhere else. It's a form of spending. With tokens with expiry date, we are looking at, if I don't use the tokens within this period of time, my tokens is gone. So there's an opportunity cost not using it. So of course I want to be using it, I want to be spending it, I want to be investing it in somewhere else. So if your objective of the ecosystem is to encourage people to be using the token more, to be transacting, to be interacting using the tokens, then that's something to consider. The other thing that a lot of people also talk about is inflationary and deflationary tokens. Inflationary means the value of one token decreases. That means that the number of tokens you need to be paying the same good increases, because the value decreases, meaning to buy the same item, you need more of the token because it's worth less. And that usually happens with infinite supply. So with infinite supply, you can keep increasing the supply to cause inflation. Just like what we see with central banks in the real world, where you just keep printing more money and you have inflation. So the value of money decreases. Deflationary is where the value of token increases, because now the value of token increases. That means instead of using one token to pay for a chocolate, I can just use half a token to pay for the same chocolate. So that's really good, right? Then of course I want to be saving more of this so that the value increases and I can sell it for more money. And this generally happens when you have finite supply, like in Bitcoin. And in Bitcoin, you only have 21 million tokens that will all ever be in existence. And in fact, it'll be a lot less, because some people just lose their Bitcoins. So it's less than that. And because there's a finite supply, people are still going to want to use Bitcoin. So then the value of Bitcoin in general increases. The supply is fixed. So each token now increases in value. So that's good. It encourages people to save. It encourages people to hold on to the token. So then it goes back to the question of, what is the objective of your token ecosystem? If your objective is for people to keep spending, then yeah, inflationary is good. Then you want people to keep spending more because you want them to spend before the value decreases by too much. Or if your ecosystem is maybe, at an initial stage, you want it to be deflationary because you want people to be saving and holding the tokens, and only until they reach a certain threshold, and you can do inflationary measures. But for the first period, you want people to be holding, you don't want pump and dump, you want the value of tokens to keep increasing, so you look at deflationary measures. So it really depends. Like there is no right or wrong. There is no it's inflation better or deflation better. It depends on your objectives that you want. It also depends on the economists that you ask. So there are two schools of thoughts. One is the Keynesian and one is the Hayek. They're on opposite ends. And for Keynesian, they say that inflation is good because it encourages spending. As I mentioned, inflation is where the value decreases. So when you first get it, you want to spend it because you don't want the value to drop even more. So when you spend it within the ecosystem, then it stimulates growth within the ecosystem. That's good. For Hayek, it says deflation is good because it encourages savings, it encourages investment. It encourages proper investment as well, because deflationary is where the value of tokens increase anyway. And now you want to look at investing in opportunities within the ecosystem that gives you higher returns than the deflationary or the increase in value of your token. So that's where you're encouraging people to make better decisions, to invest in projects that are increasing in more value and helping them to make right decisions. So inflation or deflationary kind of tokens, it really depends on your objective of the token. Another deflationary token, in general, most tokens are inflationary because the supply just keeps increasing. They have like a fixed amount of supply, but the fixed amount of supply will be generated in the span of like 20 years. So the supply of tokens keep increasing. So in general, it's a lot of inflationary. For deflationary, right now we're looking at more extreme measures. The reason why Bitcoin is a little bit deflationary in a way is because we have passed a big chunk of Bitcoin being minted. So the amount of Bitcoins being minted is less and less. It's more being minted, but it's increasing at a decreasing rate. So just less coins being minted anyway. This is deflationary. In today's world, where we want to look at very extreme examples of deflationary, we can look at BNB, which is Binance tokens, where they will just burn tokens. They will just, at specific periods, they will just burn tokens to reduce the supply of tokens that increases value. Yeah, that's one of their models. So inflation, there's no like, is it better to be inflationary or deflationary? It just depends on your objectives and your outcomes that you want. Now we look at distribution of tokens. We have to look at 3 different phases when we're looking at distribution of tokens. I know a lot of people just always think of, okay, distribution. I just want to look at the initial period, the introduction period. How do I distribute and allocate tokens at the start? And then that's it. And then I believe the ecosystem will grow and it will grow right. But when we look at distribution, we want to look at 3 different types of stages. The first one is the introduction phase. So, and then, the initial stage. And then you allow it to grow until it kind of plateaus. So that's a steady state. So we want to look at the steady state. What happens? How do we distribute? And then lastly, which is very important, is a crisis period. So the thing is, when we're designing all of these kind of ecosystems, it's impossible. It's impossible to design a perfectly robust ecosystem. What we want to do is we want to look at all the possible downsides, all the possible problems, and try to mitigate them. And that will reduce a lot of uncertainty. So we have to consider crisis period. What happens when the ecosystem crashes, when the outside world crashes, when everyone dies, there's an apocalypse. What happens? So going back to the start, in the initial phase where, you're just growing the ecosystem, we are looking at, lockup period by initial investors, like your private round or ICOs. We look at proportion cap for founders so that founders don't do pump and dump. The founders are incentivized to continue building the ecosystem, trying to grow the tokens so that the tokens kept for them will continue to grow. A bounty set aside to reward the community, because we're looking at decentralized community. We're looking at ways to encourage network effects, and bounty can be a good way to do that. You reward people for participating in your ecosystem by giving them your tokens. Wait, and is there a proportion that is pre-mined, or everything is mined, or everything will be mined on the spot, or partially mined? These are things to consider and how you're going to distribute them. At steady state, where you're reaching towards the plateau period, when are the lockup periods due? One reason is because you have to stagger these lockup periods. One of the issues that I see a lot is that initial investors are buying the tokens, they're locked up for 6 months. Everyone is locked up for 6 months. So for the first 6 months, prices of the tokens soar so high. It's like, because there's limited supply, market demand for it, and then it soars. And 6 months later, suddenly all the tokens are being released by all the investors. And all the investors are throwing tokens in, dumping tokens into the ecosystem or into the market, and then prices drop by so much. So how do you want to stagger that period? How do you want to make sure that you slowly release the lockup period? How do you determine which one to release first? Or how do you want to allocate that kind of release? Is it going to be a reward system where investors have to do something and then they can slowly release their tokens? That could also be something. We look at reserve ratio. So at a steady state, this ecosystem is backed by a reserve, or by an amount that could be in the foundation, perhaps, that supports the ecosystem. What will that reserve ratio be, and how will it change according to the demand in the market? And also, for example, in steady state, what's the ideal situation, right? Maybe for every transaction that is done, 10% of the transaction of the revenue will go to the foundation, the foundation is like a non-profit foundation that every ecosystem has. And this foundation will be managing, allocating, distributing tokens, and helping to fund tokens in terms of the crisis period, which moves us to the third period of crisis period. So how do we want to prioritize token holders? How do we want to allocate foundation funds or collaterals? When to use the foundation funds? What kind of mechanisms that are in place? So the crisis period part is talked about quite in depth when we look at MakerDAO's project. We talked about MakerDAO as a case study in the previous lesson, and you can download the token economics report in economicsdesign.com, and you can read more about what's their crisis period, how do they manage that, how will they distribute tokens, what are the mechanisms in place. So these are three phases to consider when we talk about distribution of tokens and the token policy, because token policies differ in these three periods. And how are we going to manage during these three periods? Very important. And we're going to talk about velocity. Everyone likes to talk about velocity. If you go to Medium, everyone is talking about velocity and why is velocity even discussed? Because someone, I think it's Chris Beninsky, he talked about using the quantity theory of money, which is MV equals PQ. So the monetary base times the velocity equals the price level and times the quantity. So this is how, in general, money, the quantity theory of money is created, and he has used this formula to apply them to token ecosystems to determine the price level of tokens. So before I go on into like why should we even care, why are we even talking about this, is this even relevant? What's velocity? Velocity is how frequent your tokens will change hands. So if your tokens with low velocity, will be stuff like people are just holding the tokens because they want to save it, they want to keep it, they think that prices will increase, or maybe because there is no demand for it at all, so there is no way to trade and change hands. Velocity with very high would be like tokens that are always traded, tokens with tokens that are traded a lot, or they're accepted by a lot of merchants out there. So that's velocity. So should you care about velocity? Yes and no. So yes, because it's a way to determine how active your ecosystem is. That's also quite easy to fake that. You just keep trading between each other and then your velocity will increase like mad. So yes, it's a general proxy to determine how active your ecosystem is. And this is usually quite good because, sometimes we are determining the valuation of an ecosystem or valuation of a token based on how active the token is, how active the ecosystem is. Not just what's the velocity, but just how active. And this is one of the parameters to consider. But also, you shouldn't care too much about it, because one of the assumptions that a lot of Medium articles like to write is the relationship between price level and the supply of the tokens. But it's not very true, because it's an indirect relationship. It's not a direct relationship. It's not one causes the other to happen, because price level is sticky. Price level doesn't change day to day, because can you imagine if the price of coffee changes every day because the price of coffee changes every day because the price level of the token changes every day. It's going to be very annoying and difficult, and that's going to piss a lot of people off. So because of that, then you try to equate it to the supply out there. It's not a direct relationship. It's quite indirect, because price level doesn't change so quickly anyway. And velocity is not stable. Velocity can increase or decrease based on market demand. It can be because there's a news in the market, there's more trade, or because some specific big investor is bankrupt, they need to sell, or there are a lot of factors that determine how often tokens change hands. Especially when we talk about the three different stages: introduction, steady state, and crisis period. In introduction period, you probably have a lot less velocity because there is no demand. Crisis period, you probably have a lot higher velocity because everyone's trying to sell and liquidate. And in steady state, that's probably where you get the most like natural or neutral velocity, because it's where everything is more stable, and then it's real demand instead of externalities. But unless we're there yet, velocity is going to be really, really volatile, and you don't really need to care so much about it. And money supply can also have a lot of other effects in the ecosystem, and not just velocity and price level. So there are a lot of other impacts and outcomes when it comes to money supply, and so you can't determine the price or velocity based on just money supply. And I want to talk about, I have this slide on velocity because a lot of projects that I see just like to determine, okay, my velocity is 5. How the hell do you determine 5? What's the value determined for 5? And they say, oh, because USD is about like 7, and my token is slightly less used than US dollars, so it's going to be 5. It doesn't really work like that. Sure, you can calculate velocity endogenously based on the data that you have in the past 12 months and see how often people trade. And when you have reached a steady state, you can do some basic calculation and approximation of that to determine velocity. But other than that, velocity it's really not the right proxy to determine the valuation or to determine your any like policies in place. It can be useful in consideration to determine your policies that you want to put out in place, because maybe if the velocity is really, really high, then okay, you want to go and find out why. Or if velocity is very low, you want to go and find out why. Go and analyze the outcomes or the situation. But you're not going to price your tokens based on that. So just want to clear that myth out. And we want to also talk about, so I told you about exchange rate regimes. There are 3 types of exchange rates. You've got fixed exchange rates, intermediate exchange, and floating exchange. Fixed exchange is pegged to something in a specific rate. So like, I think after the post-Bretton Woods period, US dollar is pegged to, 1 gram of gold is pegged to $35 if I'm not wrong, at a specific rate. And that's how you determine the value of US dollars. Then in the real world, you have stuff like the currency union, like euros. It's the same currency, so it's a very extreme version of pegging to the at a specific rate by everyone using the same currency. You can have like Panama is pegged to US dollars, so 1 Panama dollar is 1 US dollar. Or you have like Singapore and Brunei dollar, where both of them are controlled by the Singapore Central Bank. So it's also another extreme case of fixed interest rates, because the central bank controls both both countries, and they use the same kind of interest rate, exactly 1-to-1. In the on-chain world, we have Tether, USDC, USDT pegged to US dollars. So 1 USDC, USDT, or 1 Tether equals 1 US dollar. Or you have Bangkok smart tokens. You determine the fixed exchange rate, and this can be, this is done in the formula. You just input it into the formula. Or you have gold-backed crypto. So basically, one crypto coin is 1 gram of gold. Yeah, so that's like examples that's out there. Intermediate exchange is where the exchange rate is at a specific range of values. So instead of 1-to-1 or a fixed peg, you have a fluctuating peg. So usually it's where like Swiss francs is pegged to euros at a specific rate. I think Norwegian krones is also pegged to euros, a specific band. So maybe it's like a specific amount and then plus minus 10%. You can get to fluctuate. Hong Kong dollars also pegged to US dollars with a small minimum fluctuation, I think like a couple of percent. Singapore dollars is pegged to a currency basket where you have a lot of major currencies in the world. You also have Facebook's Libra. They are also going to be pegged to a basket of currency, like USD, Japanese yen, euros, GBP, and Singapore dollars. I don't know about Singapore dollars, but basically a basket. So then they are pegged to a specific range of values. In the crypto world, on the on-chain world, we have MakerDAO that with DAI pegged to US dollars with a 10% fluctuation. Floating exchange is where we talk about independent monetary policy that we talked about just now, remember? Where the exchange rate fluctuates at a wider range. And that's because I have my own independent monetary policy. You have your own independent monetary policy. We are not really connected or correlated. So the exchange rate just fluctuates. So there will be major currencies like Japanese yen, British pounds, and US dollars. And in the on-chain world, will be stuff like Bitcoin, Litecoin, Ethereum, or Ether. So these are the different exchange rate regimes, and your project can be put in whatever like exchange rate regimes you want, and this will affect your monetary policy or the independence of monetary policy. And lastly, I want to talk a little bit more about the leverage on collaterals. So there are two types of leverage. The first one is the reserve requirement ratio, and the second is leverage on collaterals. Remember I told you that the leverage on requirement ratio is where I borrow X amount I borrow $1,000 from the bank, and I have to put 10%, which is $100 in the bank, and I can rent out the rest, and I can lend out the rest, loan out, and earn money from that. So that means for the amount of money that I have in the bank, I can use like 10 times to loan it out and to generate revenue. So that's a leverage that I have. Leverage on collaterals is where I give the smart contract Ether, and then from there I can borrow a percentage worth of Ether that I give. So when we talk about leverage on collaterals, you have two types. One is where you have a lot of trading platforms where you give them 1 Bitcoin and you have 100 times leverage. So you have 1 Bitcoin, you give them 1 Bitcoin, but your trading capacity is 100 Bitcoins worth, and you can just trade accordingly. If you lose money, then you have to give them more money, and if you earn money, you get to earn money pretending that you have 100 Bitcoins. So the risk and reward is higher. Another way is where you're more conservative, where you give them 1 Bitcoin, but you can't do more than 100 times leverage on it. So for example, you can only take like 50%. I can only trade 50%, or I can only use 50% of the collaterals that I give you. So just in case I lose money, the smart contract or the bank or the institution is sure that there is still money in the bank, and I can use it, and I can use just in case you lose too much money. So the bank or institution is protected. So that's the two types of leverage, and they basically determine the circulating supply by having these leverage. So when we talk about requirement reserve ratio, the project I want to talk about is Bancor. Bancor uses fractional reserve ratio in the smart contract. So every time you have a reserve currency, you give the reserve currency to the smart contract, it takes a part of it as a required reserve, and then the rest will be used on Bancor's platform. For leverage on collaterals, MakerDAO gives you 66% leverage on your Ether collaterals. So the smart contract, like all these, it's governed by smart contracts and mathematics. Yeah. If I give one Ether to the smart contract, I can only borrow 0.66 worth of Ether. 0.66 worth of Ether dominated in DAI, which is their own currency, and use it on the platform. So these are just two different things to consider, and how they can be relevant to your project. Of course, this is going a lot more in depth, and this is more related to the finance world. It's more related to currency and securities. When we're talking about utilities, these can be a bit too technical, too extreme, too much. And for utilities, probably don't need so much of this. And even for stable tokens like peg tokens, if you look at Tether, they have $1 worth of token, or one coin is worth $1 because they take $1 of $1 US, put in the bank. So then that means their required reserve ratio is 100%. Because if I take $1 from you, I give you $1 in coin. I take $2 from you, I give you $2 worth of coins, or like 2 coins. So it's always 1-to-1 backed. So yeah, this will be more relevant for probably pegged tokens, securities, and currency, much less for utility. And lastly, just to give a general summary of monetary policies, where we look at the different digital currencies. So we have legal tender and not legal tender. Legal tender, once again, it's money that is issued by the central bank. Not legal tender will be stuff that is crypto, like virtual money, virtual currencies, or privately issued cryptocurrencies. The valuation comes from very different ways. So for legal tender, the valuation comes from monetary policies and stuff that the central bank does. For not legal tender, when we talk about one-to-one peg and exchange rates, it's pegged one-to-one peg. So you, like Tether, you take $1 and I give you $1 worth of coin or one coin, and that's how it's being valued. The other way of value, it's self-determined rates. So I say that, okay, it's going to be $5. One token is $5, take it or leave it. Or it can be through market forces. The market determines the valuation of the coin, of the token. So when we look at expansionary and contractionary policies, that means to increase or reduce supply. These are the kind of tools that we can use. In legal tender, we can look at increasing inflation, reducing interest rates, reducing required reserves, reducing discount rates, and that's the interbank lending rate, LIBOR, like London Interbank Operating Rates, I think. Or the government can print more bonds, can sell more bonds, or print more money. And then contractionary will be the opposite. And yeah, the government can't exactly burn more money, unlike in the crypto world where we can, burn tokens. Like the foundation can burn the tokens that they have, perhaps. But you can't do that in the real world. You can't burn money. And then in the one-to-one pegged kind of cryptocurrencies, or the one-to-one pegged digital currencies, you can't really do anything because you don't have independent monetary policy. It's really dependent on the central bank the currency that the central bank the central bank that you're pegged to. So you can't really do anything. You just have to follow and copy whatever the central bank does. Whereas if you have self-determined rates or using market force to determine the valuation, then you can play a lot more, like to do expansionary policies. You can reduce the interest rates, or reduce saving rates, increase collateralized assets. So asking more people to put the collateralized assets with you, with your smart contract, to create more native currency, to increase leverage on collaterals. So, for example, creating more native currency is just minting more, and increasing leverage on collaterals is the collaterals. Maybe you can only borrow 66% MakerDAO, but you want to increase the supply. You want to have more activities on the ecosystem. So you say, okay, now instead of 66%, you can borrow 100%. So now people can borrow more money at a cheaper rate. Of course, there are a lot of implications to all of these actions. These are just, actions that you can do. I didn't talk about the consequences. There are a lot of consequences for every action that's done. For contractionary, we can increase interest rates so that people will be saving more and people will be spending less. We can reduce supply of money by burning, reduce collateralized asset, reduce leverage on collaterals, or increase savings functions. So there are a lot of things that can be done in terms of independent monetary policy on chain.